Time now to welcome back to the show Josef Schacter, Schacter Asset Management. Joseph, first of all, really appreciate you finding time for us on the weekend here because there's a lot to talk about when we get to the oil market.
Yes, there is, Michael. Thank you very much for having me.
I want to get into several things that you've got, but let's start with a couple of things you mentioned at the World Outlook Conference, and one of them is about this supply deal, production deal with OPEC. What's your take on that now?
Well, OPEC, when we got together in February 4th, the price of oil was around $54. And at that time, I mentioned that the problem that I saw was that during the winter, which is not normal, we were going to see a build in inventory and the price of oil would go down. It did. It went down to $47 in the third week of March. And then it's rallied because OPEC is now waving the flag that they're going to continue to extend the cutbacks into year-end. And people are optimistic that that's going to balance supply. The basic problem was that even in the cuts they did in January and February, there was still an excess of supply of about 600,000 or 700,000 barrels per day. And here's just the numbers to show you what happened. When we were together in February at the meeting, the OPEC supply was U.S. storage was 495 million barrels. It's now 534. It's up by 39 million barrels during winter. Record storage in the States is 540. So we're just 6 million barrels from record storage. So the issues we brought up at the time were correct. So anytime you have a correction from 55 down to 47, it's not going to go straight down from there. It's going to bounce back to the breakdown area, which is 50, 51, 52. That's what I think it's going to do. But in the next couple of weeks, as the weekly EIA data starts coming out and the numbers show a build, we're in the shoulder season now when demand falls by 1 million barrels a day worldwide from the winter. And the other point is a major pipeline, the Dakota Access Pipeline, which has kept oil in the Bakken locked in the state of North Dakota. That pipeline comes on in the next few weeks. The oil's already filling the line, and they're going to turn it on, and that's going to add 470,000 more barrels to U.S. production. So it's going to go from 9.1 to maybe 9.6 million barrels, the highest level we saw since the summer of 2015. That's going to drive prices down. And my expectation is during the month of April, we go down below 40, and potentially in May, June, if OPEC does not pull a wild card out of their rabbit out of their hat by saying they're going to cut another 2 or 2.5 million barrels, we have a chance to go down to the low 30s during Q2. If OPEC does anything saying they're going to try to save the day, then maybe it gets dragged into the third quarter. The bottom line is the fundamentals are bearish. They're staying bearish. They're getting worse. And OPEC can pull a few magic rabbits out. But the bottom line is U.S. production is rising at $50 pricing. And so the problem OPEC is they have to cut back severely. If they don't cut back severely, they lose the game and the price goes down.
A couple of things there, Joseph. Just forgive me. I want to back up just for a sec about this supply issue. I mean, I know it may sound straightforward, but I don't want to lose anybody on that. The significance of how much has been storage. I mean, that's obviously part of the supply-demand, but the significance of how much is sitting in storage. Can you elaborate for us?
Yeah, normal U.S. storage would be around 300 million barrels. So we're sitting as of last Wednesday's data at 534 million barrels. That difference of over 200 million barrels is owned by speculators. So people who are betting on the price of oil, not only are they buying in the paper oil market, which is the futures oil market, they're also doing it in the physical market. Commercials, which are the professionals, the refiners, the people who know what they're doing in the industry, are sitting at high levels of short position. It's the speculators that have been buying in the physical and in the paper market. And again, you can hear so many stories about the gold issue and that the physical gold demand is fabulous. And the problem is the paper gold market is stifling what's going on in terms of price action. We now have both the paper market and the physical market very bearish for oil.
And let me go further with this. The other thing you mentioned, it's something that we've been talking about thanks to you on this show and at the World Outlook conferences. I was worried, or not worried, I was just stating that if OPEC cuts, and they're even successful in that cutting, it doesn't matter because if prices get up to, say, $50, you see this huge supply coming on stream out of the States. And that seems to me, they can ramp up production there so quickly in those fracking operations, and that's what we seem to have seen.
Yeah, and the U.S. government is talking about 1 million barrels a day coming on from fracking because of the the Permian Basin, the Eagle Ford, the Bakken now with the new pipeline. A lot of it is takeaway capacity, pipeline issues. Well, when you had Obama in power, there was no pipeline approvals. Now that you've got the new change in regime, we've already got the XL pipeline moving forward. We got the Dakota Access pipeline moving forward, and FERC has in front of them, the Federal Energy Regulatory Commission has 4 pipelines in front of them for I think $13 billion to bring on more oil and more gas in the main new basins of the Marcellus and the Permian and others. So if those go through, then all of a sudden the facilities issues will be resolved, and in the massive amount of drilling that's happened, where there's a lot of drilled and uncompleted wells, the reason you drill them is because you have a firm commitment with the person who you farmed in on the land issue, but you can't put the well on and you don't complete it unless you have pipeline access. Those issues are being resolved. It wouldn't surprise me if the U.S. production was over 10 million barrels by the end of the year, and that's from 8.4 million in the summer of last year.
Back to supply. What happens when they sort of, they have storage capacity, of course, for oil? That's what we're seeing. Sometimes they're even put in tankers, et cetera. But what happens when that gets to the sort of brim, that they've got all this oil stored and there's no more room for it?
That's the point I think will happen. What will happen is a number of things. One, people will realize that there's a shortage of supply storage, and so contangos, the storage costs will go up sharply. That's what happened in 2009 when the contango went to double digits. Second, you'll see that a lot of players will shut in production, and in the Middle East, the OPEC producers will have to say, how desperate are we for revenues? And if they're desperate and they have like $2 or $5 costs, they can sell oil at $26 like they did in January of 2016. And to me, that is the basic issue why I don't know how low we go. I just think that one window is potentially the end of Q2. The other one is near the end of the year. If it happens in Q2, maybe we only go down to the low 30s. After a bounce here, maybe of another $1. On the upside, 52. But then when the EIA data comes out, we head lower. And if OPEC pulls a few rabbits out of the hat, and then we have to wait for more proof of what's going on with storage, plus the issue of Libya and Iran and Iraq, which are saying they're not playing ball, they're bringing on more production, Nigeria bringing on more production, then all of a sudden OPEC loses, and unless they pull back supply by 2 to 3 million barrels, and of the 1.2 million so far, 800,000 has been done by Saudi Arabia. So if they pull back by 3 million in total OPEC, Saudi Arabia has to pull over 2 million barrels. They have not agreed, and they've not even given a hint that they're willing to do that. That's why I think there's a possibility we may even go back down in the later part of the year if there's no success by OPEC in terms of doing anything. We go back down to the lows of January, February of 2016, which would be very ugly for the sector. And that's why, as we said at the time at the World Outlook Financial Conference, sell, stay on the sidelines. We had a fabulous buying opportunity in January, February 2016. We went out and gave you a long list of names to buy, and we had them on the list. We showed them to you again on February 4th at the 2017 one. And just showing you a few examples how cheap stocks got. Birchcliff Energy, which was one of our top picks, we had it as a purchase price between $3 and $3.20. It went down lower than that price, so it just shows you how cheap bargains can get to $2.85. Well, we had a $9 target. It went to $10.50, and at $9 we removed it from the recommended list. A name like Penn Growth, we thought between 70 and 90 cents would be cheap. It went down to 66 cents. We had a $2.70 target, and when it got there, we removed it. And then the last one, just telling you about, was we thought the service sector was attractive. We gave 3 names, Trinidad Drilling being one of them. At $1.50 to $1.70, it went to $1.44 on the low, and then the high level was $3.77, up 150%. So there were some fabulous wins, but then in June of last year, the storage problem came back, and we said the word sell. Since then, the price of oil has gone down. The price of oil is flat. We're still around the same level in the low 50, 51, but the index has gone down by 12, 13%. So we've had a severe correction. Things like C&Q and others have held up, but you have a lot of stocks that are down more than 50%. There's bargains out there now, but we expect there'll be even more bargains moving forward. And our new product, which you highlighted on the news or the release about the program, it's called the Schacter Energy Report.ca. And we're now, our name has been changed. Our lawyer suggested we change the name from Schacter Asset Management to Schacter Energy Research Services, Inc. People can go to the Schacter Energy Report. And this week, we finally, after 2 months of doing all the back office, we have fabulous IT people. Patty's been handling all the back office admin to get this ready. I've been working on the product side. We're now up and running so people can go to the website. And we've said that the first newsletter, the monthly, will come out at the end of the month. But I've been working on the product side, and I've got 5 companies already done. We want to have 20 on the coverage list within the next 3 or 4 months. So when the buying window, if it gets as cheap as it did in January, February, we can then go and send out action alerts saying these stocks are bargain basement levels, buy. And then we could have, and there's 2 product levels. There's the monthly report and then the black gold report. People can check off which one they're interested in. But we may be producing the report earlier than the last week of April, so people in the next 2 weeks should make their decision if they want the product and sign up.
Give me the website again, please, Joseph.
www.Schacter, Schacter, energyreport.ca.
Perfect. Josef Schacter, my guest, will come back. I got a couple of questions that beg from that analysis, but it's an exciting time. And I want to reiterate, by the way, that Joseph gave this list to us at the 2016 World Outlook Conference. Those stocks performed spectacularly, but I want to clearly understand that he also then got out of those stocks. But he said at this year's World Outlook, he's looking for the buying time, too. He predicted this sort of drop. He obviously thinks more is coming, but he predicted the buying time. And we'll get more into that when we come back right here on the Money Talks Network. TER. SCHACHTER. So it's SchacterEnergyReport.ca. It's a brand new service, big demand for that kind of thing. And really, this is an easy business. I always say being right is what counts. Well, Joseph's got an excellent track record, which is why, of course, I called him in the first place. He's been a great friend of our show for many years. But this is a fascinating time. And I think personally, and I won't put words into Joseph's mouth, I'm always looking for the big moves. And Joseph has certainly chatted with me and chatted with Victor Adair about the decline he sees coming, setting up a big move. Well, Schacter Energy Report, of course, will chronicle that and the timing and give as he said, a list of stocks where you can certainly take advantage of that. Joseph, I want to come back to a couple of things. Very straightforward. Okay, we've got a supply issue. If they're going to keep prices stabilized, you're talking about a 2 million barrel per day cut from Saudi Arabia, another 500,000 elsewhere. But really, how likely is that? As you said, barring a few surprises may change the timing from the second quarter into later in the year, but still, I just don't see that happening. I don't see them willing to support the market to that degree.
Yeah, they don't like to do it. They've done it 3 times over the last few decades. They did it in 1998-99 when they stuffed too much product into Asia, and then they had the financial crisis in Thailand and Korea, and then they had to cut over 3 million barrels via 3 cuts. And then, of course, 2000, 2001, they didn't have any choice. Of course, 9/11 doesn't give you much choice, and OPEC was stuffing the channel. They had to cut 5 million barrels over 4 cuts. And then in 2008, 2009, again, an unfortunate event they had no control over, they had to make 2 cuts of 3 million barrels to balance supply and demand. So to me, it's not something that they want to do, but they're forced to do it by events. I don't know if it's a market event. I don't know if it's the love affair with Trump that now people see he can't get Obamacare withdrawn. Maybe he doesn't get his tax things done. Maybe it's the border tax. You don't know what it's going to be that's going to shake the markets. But if there's something like that, and that then gets the margin clerks aggressive, then all those people who are long crude oil or the OPEC countries that are stuffing the channel with physical oil, then we have the hiccup, and then we come down, and we come down hard. So I'm looking either at that low 30s, potentially June, if we don't have anything from OPEC, if OPEC tries to put a Band-Aid, tries to say they're going to extend till the end of the year or do what they can, it's going to probably be third quarter, fourth quarter, and then we go lower than we would in June. So to me, it's a lose-lose for OPEC, And the reality is when there's too much of a product and it's levered in the hands of weak owners, i.e. it's not in the hands of the commercials being long who are refiners who can use it, it's in the hands of speculators who are leveraged. And, of course, if the leverage goes against them, it's a very nasty margin call, and they're leveraged both in the physical market by 200 million barrels, and they're leveraged by almost 1 billion barrels between Brent and WTI futures. It really could get very ugly.
Just very quickly, the other side, as we alluded to, is that if they do cut production, I just see the U.S. being able to make up, a chunk of that very, very quickly. Now, I mean, they've just proven to be able to do it, but we also have Canada that can jump in there. You've got Nigeria, you've got Russia. Well, we'll see about Russia, but Libya able to do it.
Libya, Nigeria. Here's one for you, a stat you won't believe. But last week's data for the EIA, the U.S. data, they show Canada shipped to the United States 3.2 million barrels. So we produce about 4.4. So about a third of U.S. imports comes from us. The interesting thing was Venezuela was up by 404,000 barrels to 975,000 barrels. Somehow they were able to buy diluent to ship product into the States. And the other one was Nigeria. Nigeria sent in 436 million barrels, and that was 436,000 barrels, up 326 from the week before. So you've got two players that you'd never thought would be able to increase production, Venezuela because of all the political issues there, and Nigeria because of all the difficulties with the Niger Delta, and yet the U.S. import data shows those numbers. So that tells me there's a problem out there, that if weak guys like that can get oil into the States, what about the U.S. production rise, and what about the fact that Libya is coming back big time?
We got to leave it at that, Joseph. And I'm going to give the report name again, but it's SchacterEnergyReport.ca. I'll give that again when we come back right here on the Money Talks Network.